Thank you, Lucas. And as mentioned, we will now begin the Q&A session. For those listening by phone and would like to ask a question, please press star followed by 1 on your telephone keypad to raise your hand and join the queue. And to withdraw your question, press star 1 again. Your first question comes from the line of Max Yerrill at BMO Capital Markets. Your line is open.
Hey guys, good morning. Thanks for taking my question. It looks like we're starting to see some of the positive impacts from the ore sorting initiatives. Do you think these head grades and recoveries are now more representative of what we should expect moving forward in the next coming quarters?
Sorry, Max is on mute. I was chatting away to myself. Sorry. Thanks for your question. So Max, Sylvain and the team have certainly done a lot of work around both our mining strategies, our stockpiling, ore sorting and ore blending, and those benefits are being demonstrated through the improved recoveries. Probably a couple of points to note. The grades that we saw mined and processed during the quarter are still below the long-term averages of NAL, so there's increased potential there. So whilst we made excellent progress, the ore body's long-term average grade sits above where we were last quarter, which obviously gives us increased confidence in terms of the results we expect to see during the expansion as it relates to the recoveries and so forth. So again, Sylvain and the crew have done a great job, but there's still more to be done.
That's helpful, thank you. And then one more, if I may. With the old legacy contract moving behind us now and moving to the new commercial terms, is there a potential to increase the cadence of shipments? There's this 41,000 tons sitting in inventory. Is there potential in the near term for a third shipment per quarter?
Yeah, Max, I'll just provide a couple of comments before passing over to Christian Cortez, who looks after our marketing. The primary driver for the cadence of shipments that we've seen to date has been around minimising freight. And when NAL first restarted, we were sending lots out in 15,000 tonne cargoes, which obviously provide a more regular cadence. The issue is that it costs you probably around another $60 to $70 a tonne more of freight costs by doing that. So we've typically clubbed those volumes together into larger shipments. So it's really a case of us being able to minimise shipping costs, but I'll pass to Christian for anything else he might want to add in future outlook.
Hi, Max. Look, I first probably talk about what happened in the previous quarter. We did have a changeover on port at the end of June, which basically meant we had to shift towards building inventory at the new port. That, to some extent, limits how much volume we could move in the quarter. Saying that and putting last quarter behind us, as we look for the next 6 months, those volumes on a quarterly basis will increase. I would expect to ultimately see 2 shipments per quarter, and on a combined basis, that should be somewhere between 50 and 60,000 tons. So we will see more volume as we move forward. And just adding to what Lucas was referring to, we obviously keep an eye on assessing cost-benefit here. There has been ultimately an initiative to reduce the cost on the shipments. We are following a schedule with customers that is, to some extent, changing as we move into the new agreements. So that will allow us to assess when there is an incentive to get smaller cargoes out there, with a view that we can maximize price. We will certainly do that as well.
That's helpful. Thanks, guys. I'll turn it back over.
Thanks, Max.
Your next question is from the line of Reg Spencer of Canaccord Genuity. Please go ahead.
Thank you. Good morning, everyone. Christian and Lucas, just after some comments on market conditions, clearly we've seen a pullback on market prices over the last couple of months, and I guess we could put that down to prospects of new supply coming back into the market. But demand does look robust, and at least to us, there's not a lot of obvious new supply alternatives coming into the market. So can I ask what are your guys telling, or your customers telling you with respect to their outlook for overall market conditions as you move into the second half and into 27?
Hi, Rich. Thanks for the question. I think as we get feedback from different channels, call that customers, call that parties that are looking to source volume as we move forward, and in addition to that, independents are observing the market. I think it's fair to agree with how you're currently describing it. The fundamentals are still very strong. There's nothing that suggests that demand will weaken in the short term. With respect to, I guess, the reaction on the market on the buy side, yeah, there are ultimately indications that we'll see more supply coming in, primarily from restarts, in addition to a couple of new projects gradually building up volume as we go into 2027. So my view is, inventory levels continue to be relatively thin, and therefore our read of the market is a reaction towards sentiment driven of a potential increase in supply coming in the near term. Now, whether that's going to come from Yangtze or whether that's going to come from restarts of Africa, I can't really tell you. But I think as we've seen GFEX is already pricing that, and that ultimately puts some level of pressure on spot pricing in China. But all in all, we continue to see the short-term 3 to 6 month window pretty strong in terms of fundamentals.
Great. Thanks, Christian. And just last one from me for you, Lucas, if I can. Have you got an idea on when you might complete updated studies for Moblem? And have you guys put any additional thought into how that project might be scaled or scoped in terms of production capacity?
Yeah. So, Reg, we've actually awarded the scoping study for Moblem. It'll be delivered in this half. The key objectives really sort of twofold. One, just given the increased resource base, to determine really what the optimal production level for Moblem is. And just as a reminder, the previous DFS had annual production around 300,000 tonnes. The resource base has grown appreciably since then, so we expect it to support a much higher level of production. Combined with that, we also want to really sweat the approach on the capital investment and potentially whether that's staged. So that'll be the primary objective of the scoping study, which we'll deliver this half. And then from there, we'll roll into an updated DFS.
Understood. Great. Thanks very much. That's all from me. Thanks, guys.
Thanks, Reg.
Your next question is from the line of Austin Yun of Macquarie. Please go ahead.
Morning, Lucas and team. Just a quick question. I understand the legacy contract going to roll off. So could you please just, remind us how the price is linked going forward basis? Should we think, like 1 month delay, or if there's any additional sort of, nuance adjustments required for the next 12 months? Thank you. Bye.
Thanks, Austin. Yeah, you're absolutely right. So that legacy contract is now very much in the rearview mirror for us, and I'll pass over to Christian to describe the sort of contract terms in terms of delays and so forth, or pricing periods, provisional period pricing periods under current arrangements.
Hi, Austin. Look, it continues to be a combination of, I guess, month on pricing. However, that being said, we're no longer carrying those, big lags that we described in the early report as well as on a quarterly. What do I mean by that? I mean, primarily there's potentially 2 that I can summarize here. One of them is you price on the month that you ship, and that ultimately, stays on the water for 2 months prior to getting to the customer. And there's a second category which we are effectively exposed index all the way until delivery, and you then take effectively the average of the month that you delivered on. So that will allow you to then, I guess ultimately figure it out. If you take a midpoint of what you saw in the quarter, it would effectively match that on the basis that we are shipping twice in the quarter, once at the beginning and once towards the end.
Cool. That's clear. Just a quick follow-up on the unit cost, which has been pretty good for this quarter. My understanding is that there's a bit of a favorable inventory movement. So just to strip that out, how should we think about just, the pure cash cost performance for the business? Just try to get some color for the, again, for 27. Thank you.
Thanks, Austin. Probably if you were to think about it on a cost of production basis rather than cost of goods sold basis, in short, our unit cost of production was a little lower than last quarter. In short, as we highlighted in previous quarters, we have got an elevated level of stripping going on the mining side of things, but that's been largely consistent for the last 2 quarters. So we consider that we've got a stable cost of production. Obviously, as we progress through those underground stopes over the next 12 to 18 months, effectively those incremental costs will drop away as well. It's also fair to say we put a little bit of additional mining inventory into the system as well as we ramp up ahead of the NAL brownfield expansion and increased milling capacity. So actual cost of production on a cost basis actually reduced this quarter slightly, Austin, as compared to the previous quarter.
That's clear. Thank you. I'll pass down.
Thanks, Austin.
And before we move on to the next question, a reminder, if you would like to join the queue, to press star 1. And your next question comes from the line of Andrew Harrington of Petra Capital. Your line is open.
Thank you. Morning, gents, and thanks for that clear explanation on the pricing. That was going to be my first question. And my second one is in terms of the NAL expansion, will there be any disruption to operations that we should look towards in the coming periods as you put the tools to work?
Thanks, Andrew, for the question. In short, no. The way that Sylvain and the project team are structuring that work is that any tie-ins will do during the course of regular maintenance shutdowns, Andrew. So we're not anticipating any extended or prolonged periods to be able to cut across the additional equipment that we'll be installing.
Okay. And no impact on pit operations either?
Sorry, just say that last part again.
And any impact on in-pit operations?
Oh, no, short answer is no. Again, Sylvain and the mining team have actually increased inventory ahead of that, and so one of the key elements is making sure we've got sufficient ore exposed and adequate blending options to be able to sort of maintain the recoveries as we've seen in the last quarter.
Okay, thank you. That's it from me.
Thanks, Andrew.
Your next question is from the line of Levi Spry of UBS. Please go ahead.
Well, good day, team. Just wondering, please, now with the Tesla contract run-off, sort of expectations going forward of any discount to spot pricing moving forward based on sort of grades and just rough thoughts there.
Hi, Levi. I mean, we obviously have a contract with Mitsubishi, who is not an end user. There is not a discount on the price, but there is a commission, and the way we effectively report prices on volume that gets allocated and sold by a Mitsubishi, there is a discount on the FOB that we take net of commission. That aside, as we're having discussions with customers for future offtakes, the expectation is that there is no discounts on market prices as we bring those contracts into the customer portfolio.
Thank you. Is there, like, the Mitsubishi commission sort of fees, is there any detail that we could look at around that, just sort of working out if it's material or not, or is there sort of any detail you can point to?
Well, it's not a specific percentage on a fixed basis. It moves around depending on what price and profits are looking like. I mean, I've been exposed to a few of these. I can tell you there's nothing that suggests that this one is unique. So, it would be in the range of what you usually have traders effectively taking commission as they move the product.
Okay, thank you.
I think, Levi, the other point I'd just add there is, we spent the last 12 months cleaning up legacy contracts and so forth, so we certainly won't want to be replicating any of those elements going forward.
Noted. Thanks, Tim.
Thanks, Levi.
And there are no further questions on the phones. I would like to hand over to Andrew Barber for written submissions.
Thanks, Ollie. Lucas, could you just explain how long the shutdown was in April, please?
Yeah, it was just under 4 days and 85 hours in total.
Great, thank you. And Christian, with the reduction in the prepaid facility, how was that done, and were there forward sales contracts used for that?
The facility gets drawn down against future shipments. So at the end of the quarter, we had fully drawn that facility. It will be paid back as we effectively sell volume into the market, and hence why the $9 million that we disclosed there was the first payment that we've undertaken since we raised the funds. I would expect to see that prepaid facility, if not fully paid, mostly paid by the end of the calendar year.
Great, thank you. A further question is, considering the substantial inventory we had at the end of the quarter, was there an opportunity to make an additional sale during that fourth quarter of the year?
Thanks, Andrew. As I've touched on during the previous questions, we changed ports at the end of June. As a result of that, it was very difficult for us to effectively run shipments in addition to those that had been contracted for in the quarter, saying that we had already shipped just over 30,000 tons in the month of July, and that effectively is the reflection of us cutting across into the new port and building that inventory at port as we finished last quarter.
Great, thank you. Now a question on the expansion, and the context is in with the strong quarter that we've just had, the first stage of 15 to 20% increase in production. Could you just clarify what the starting base and base production level should be for that 15 to 20%?
Yeah, thanks, Andrew. As per the guidance that we had provided as part of the NAL expansion scoping study, people should think of that base at around that 190,000 tonnes, and us building off there, so in the order of 220,000 to 230,000 tonnes thereafter.
Great, thank you. And can you comment on how Mangrove's new Delta test plant is performing for their conversion process?
Yeah, we were certainly pleased to see them commission or officially open that and then obviously commission and ramp that facility up. Probably Mangrove are best placed to provide the market with updates on that, other than to say we continue to be engaged in moving towards combining a definitive agreement in relation to the previously announced non-binding MOU offtake arrangement as well. That provides a heap of benefits for us in terms of providing both floor protection and also ability to be able to reduce our freight costs as well. So Andrew Barber's working away diligently on that, and as I said, we're progressing towards a definitive and binding agreement.
Thanks, Lucas. In terms of the operations, have we completed working through the areas of lower grade that were encountered earlier in the year?
As I mentioned earlier, the grades that we encountered during the quarter were actually lower than the life of mine average grade for NAL. So it really is testament to the good work that Sylvain, the geologists, the technicians, the metallurgists and the mining teams and the plant and process operators have done in terms of moving through that. So we will see periods where the grades will be higher than we saw last quarter as we move forward as well. But as people appreciate, the ore body's not homogeneous, so there will be variability from quarter to quarter. But as we've seen, we've been able to demonstrate a high level of production performance even when the grades are sat below the long-term average of the ore body.
Great, thank you. And Christian, question for you. How do tax rates and payments vary by jurisdiction, say between Australia and Canada, and are there any tax losses from previous years that can offset current tax liabilities?
Okay, so I'll focus on Canada because it's ultimately the main jurisdiction that is driving profitability, and you know, we can obviously disclose a lot more in the annual report. In Canada, we are subject to mining tax, and we are obviously subject to paying corporate tax when there's profits. We are carrying forward losses in Canada, and that is circa of 200 million Canadian. That basically allow us to obviously amortize those losses in the short term, and we would then, you know, be paying the mining tax in the earlier years or in the next couple of years as a result of that. I would probably phrase it in a way that my expectation is we're single-digit percentage-wise as a measure of profit in the next couple of years, and that rate, you know, increases and builds up to maybe mid-20s as we fully amortize the losses, as well as increase production and profitability. So again, at high level, I'll obviously, you know, put a little more information out there with the annual report, and we can expand on that question once that information is out.
Thanks, Christian. There are no further questions.
And with no further questions, that concludes our Q&A session, and I would like to hand back to Lucas Dow for closing remarks.
Once again, just want to thank everyone for joining. Also appreciate the questions, and obviously we're looking forward to an exciting FY 2027. So thank you, and we'll talk to you soon.